AppLovin might be one of the most misunderstood AI stocks right now because at first glance, you'd think this is just another mobile ad company that got caught up in the hype. But that's not really what's happening here, and it's got my community all up in arms. AppLovin has quietly built an AI engine called Axon 2 that doesn't just show ads based on stale data. It reads fresh mobile signals, predicts what users are likely to do next, and then feeds those results right back into the system. And now that AppLovin has sold off its gaming business, the story has changed in a big way. You're no longer looking at a game maker. You're looking at a high-margin software platform that could become the toll booth for mobile apps. And that's why in this video, I'm going to break down 3 things. First, why Axon 2 is so powerful. Second, why the move beyond gaming and into e-commerce may be the real catalyst. And third, what all of that could mean for AppLovin stock from here. My name is Rick Orford. I'm a Wall Street Journal bestselling author. I've been trading since 1999, and no, I'm not a financial advisor. That is a good thing. I break down the numbers so retail investors like us can make smarter, more confident decisions with our money. I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. And you all know how much I love researching new stocks and trying to find the next best investment. So I'm proud to partner with The Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market by almost 6 times. Go to fool.com/ricko to get your 10 stock picks right now. All right, so before I get into the AI side of the story, let's set the stage. AppLovin is a company that helps app developers find new users and earn ad revenue. And over the past 2 years, AppLovin has gone from a fairly obscure mobile gaming roll-up to one of the most talked about AI names in the market. And the reason comes down to one single piece of technology. That's the Axon 2 advertising engine. Now, traditional ad systems usually work by figuring out what to show you based on what you bought, what you clicked, or what you looked at before. But Axon is different. It tries to figure it all out in real time. It looks at what you're doing on your phone right now, and then predicts which ad you're most likely to act on. You get the picture. And that matters because fresh signals are usually more useful than stale ones. I mean, it makes sense, right? If an ad system uses fresher data, can actually match users better, price ads more accurately, and send advertisers better traffic, well, that's the whole idea here. And AppLovin already sits inside thousands of mobile apps, and the system can actually see whether those ads convert. Then it feeds that result right back into the model. And that closed loop is what traditional ad networks just can't replicate as easily. And the second piece is cost. Axon 2 is said to be more cost-effective to run compared to previous ad engines. Now, that may sound like a small thing, but in high-speed ad bidding, it's a very big deal. Because if your platform can price an ad more accurately and do it at a lower cost than the other guy, well, you get to win much better margins. And that's why AppLovin's profit numbers are so good, at least compared to the rest of the industry. And this is where the business itself becomes just as important as the technology. Because this part trips up a lot of people. For most of AppLovin's history, the story had 2 moving parts. There was the app segment, which was a bunch of mobile games that AppLovin owned outright. Then there was the advertising segment, which is where Axon 2 lives. But the gaming segment is gone. On June 30th, 2025, AppLovin closed the sale of its entire mobile gaming business to Triple Dot Studios for $400 million in cash, plus roughly a 20% equity stake in Triple Dot. And that deal handed off 10 game studios, including names like Machine Zone and People Fun. And just as important, it pulled off the hit-driven, volatile gaming revenue out of the company. That's a big shift because now what's left is the part that matters most. AppLovin is now a pure marketing platform, and the financials, they show it. Adjusted EBITDA margin for the first quarter of 2026 came in at 85%. For context, a healthy software company is usually shooting for 30, maybe 40%. And AppLovin is running at more than double that on a revenue base that just crossed 1.8 billion in a single quarter. So to me, this pivot to a software-first model really de-risks the company. Because the market used to worry about, well, if the games stopped being hits, then maybe the business would fall apart. Well, now the games are gone. And the software platform can keep scaling across millions of other apps. So at this point, you're no longer buying a game maker. You're buying the toll booth for the mobile app economy. And now the next question becomes pretty obvious. If this worked so well in mobile gaming, where can AppLovin take it next? Well, for years, the company sharpened its AI on mobile games because gaming users are easier to track and the data is cleaner. Now, the new chapter is e-commerce and general consumer apps. Picture this. Let's say a Shopify owner wants to find customers who are more likely to spend money. Well, instead of relying only on Google or Meta, well, that store owner could use AppLovin's system to target mobile users with the same kind of precision that worked so well in gaming. And that capability is rolling out right now. And to me, this is the biggest catalyst on the table. For a long time, if you wanted to scale a mobile brand, your only real options were Google or Meta. And that lack of options, well, it's gotten expensive. Plus, thanks to privacy changes in recent years, it's become less effective for a lot of advertisers. And that is exactly where AppLovin comes into play. It's offering an AI-driven alternative built for mobile performance. And if it works, it can pull ad dollars that used to go straight to the big guys. On the latest earnings call, management said that the consumer vertical, which includes e-commerce, contributed to the 59% year-over-year revenue jump in the first quarter of 2026. And that's important because it means that this isn't just a nice idea sitting in a slide deck. It's already showing up in the numbers. And if those margins hold as the vertical grows, AppLovin has a real shot at becoming the back-end engine for mobile monetization across the entire app world. Now, let's get into the actual numbers because this is what moves your portfolio. In the first quarter of 2026, AppLovin reported $1.84 billion in revenue, and that was up 59% from the year before. Net income hit $1.21 billion. Diluted earnings per share, $3.56. Adjusted EBITDA was at $1.56 billion at that 85% margin. And free cash flow in the quarter was $1.29 billion. For the full year 2025, the company put up $5.48 billion in revenue and $4.51 billion in adjusted EBITDA. And it also bought back 6.4 million shares of stock for $2.58 billion during 2025. And that's something I think you should pay attention to. Because when a stock is trading at its all-time highs and management is still buying back this aggressively, you'd honestly expect there to be a reason, right? Well, I say they're basically telling the market that they still believe the stock is worth owning, even after the run. Now, before I go any further, I do want to flag the debt. AppLovin took on real leverage to fund earlier deals, and a heavy debt load is always a risk if interest rates move the wrong way. The interest coverage is fine right now because EBITDA is exploding. But if the ad platform growth ever slows down while the debt is still sitting there, well, this story can flip pretty quickly. The cash flow handles it all right now, but the balance sheet is the thing that worries me, and I would keep an eye on it. And before I get into whether the stock is too expensive, there is another practical angle worth thinking about. If you've been watching AppLovin but think, look, it's still way too expensive, maybe you want to buy it 10, 15, 20% below where it is today, check this video up here because I talk about how you can sell a cash secured put on a stock you want to own and get paid to wait for it to potentially come down to your price. And get this, if it does, you get to buy it and you got paid to buy it. Now, that strategy isn't for everyone, but it is one way that retail investors can react to a fast-moving stock without just chasing it at the top. So with that in mind, let's talk about the question I get most in the community. Is it too late to buy the stock? Well, AppLovin trades at a forward earnings multiple that's higher than most legacy ad tech names, but often comparable to or even cheaper than the higher growth AI infrastructure crowd. Right now, the company's trailing price to earnings ratio is around 43 times. Now, if you value it like an old school ad company, well, sure, it's expensive. But if you value it like a high margin AI software platform, the multiple starts to make a lot more sense. And to me, the real risk is the AI premium itself. I mean, if the market decides AI software suddenly isn't worth as much as AI hardware, AppLovin could see its multiple compress even if earnings stay strong. And the other variable here is regulation. For example, Apple's privacy changes. They hammered the industry just a few years back. And although Axon 2 was able to solve that problem, any fresh changes from Apple or Google could create a short-term headwind. So with AppLovin, I say you're betting on their ability to stay one step ahead of the gatekeepers. And that's the real balance here. The business is stronger than it used to be. The margins are incredible. The e-commerce opportunity could be massive. But the stock already reflects a lot of excitement. So how do you play this out? Well, for long-term holders, the story here is just software platform revenue growth. That's it. As long as that line keeps running along with the margins, the stock has a real floor under it. But for traders, watch the consumer vertical. The moment AppLovin posts a clean, measurable win in e-commerce, that's going to be your proof point, and that could be the catalyst that sends the stock higher. The most important part, though, is that AppLovin has actually crossed over from a risky gaming company to a high-conviction AI software play. From here, the story becomes an execution story, not speculation. If the e-commerce push lands, today's all-time highs could look like a footnote. But I'd still keep the position sizes reasonable because the market is brutal to anyone who gets greedy at the top. So that's my take on AppLovin's current position. But what about you? Do you think focusing on the mobile advertising business will move the needle for AppLovin? Are you buying, holding, or selling the stock? And is there anything else that I missed in this? I mean, did I get it right? Did I get it wrong? Tell me everything. Give it to me in the comments below. And while you're there, of course, if you found the video helpful, don't forget to like and subscribe because it helps others find the video, it supports the channel, and it makes sure that you don't miss out on my next deep dive. Well, that's it for me today. Thank you so much for watching, and I'll see you next time.